Welcome back to another episode of Investing Explained. Here's today's question.
Fantastic question. This really kind of gets at the heart of what our good friend Toby Carlisle is all about. So Toby wrote a book called Deep Value, and it really implements this net strategy where you go into the balance sheet, you find a company that has strong earnings that's being sold at a very steep discount. But the difference between what Toby's doing and what Toby's recommending and what Warren Buffett is doing is that Toby is consolidating picks across 20 to 30 companies that have been filtered down to give him those results. And his analysis in his book talks a lot about mean reversion and that these companies have been penalized so severely and been just punished that they have such a large amount of price action to move within just a short amount of time, call it 1 year to a year and a half, that they can recuperate to a normalized price to earnings ratio, and that you can take advantage of this if you do it in a batch. If you do this across a portfolio of companies that are all similar in the way that they're valued, not similar in the way that they're performing in the same sector or anything. So Buffett got away from this approach and he went into a much more qualitative approach where, as you said, he's trying to find a great company at a fair price. And he morphed away from this deep value approach and he really started placing a lot of emphasis on companies that have this enduring competitive advantage and that don't have a lot of tangible assets. But he's doing it more in a manner that he's handpicking a specific company. Now, the reason I think that he had to transition, and this is just my personal opinion, I think some of it had to do with his experience with Berkshire Hathaway early on. I think that drastically shaped the way that he saw things because he saw these people that in the town that were all up in arms, and he was the Grim Reaper who was going to kill the business and, liquidate it and make a profit on the sale of all the assets. And as he went through that was a life-changing event for him. And then Charlie Munger said, you need to value the company as if it's living and not that it's getting ready to die tomorrow. That changed him. And then I think something else that has a big impact on him is the amount of capital that he has to move. He has to look for companies that are better alive than dead, if you will. And I think that that's another reason why he drifted into a different direction. But for the person who has a much smaller amount of money that can filter results based off of what Toby would call the enterprise value, I think that approach is very useful, and I think that it can provide just amazing returns for people that are implementing it. I'm a huge proponent and advocate of what Toby's book talks about and what it recommends.
I think this is a really good question too, and also think it's a very complex question because it really depends on one's skill set. And I want this to come out the right way because it's not me saying there are only so and so many people that are smart enough to do this. Not everyone can do it. But I think it's really difficult to do. And since you're specifically talking about when you're just starting out, I'm not necessarily sure that what we call special situations is the right way to begin, even though that was how Warren Buffett began. I think there are a lot of reasons to this. As Preston also stressed, you can, even as a beginner, I guess, or at least with little experience, do something like Toby because it's all automated and you are diversified. I think it's really, really hard if you're going into this special situations or nets, if you are picking individual stocks and perhaps putting more than 5% in one pick, because it tends to be very complex. And it tends to be complex for a lot of reasons. One reason is that you will be looking at a lot of catalysts. And yes, very often you'll see value being catalyst in itself. But for a lot of these companies that are highly undervalued or really small companies sometimes with a lot of debt even, it's not always that easy. You might be waiting for that catalyst that someone will come and liquidate that company. Now, the thing is that as a small investor, even though you bought it at a really good price, you don't have the authority to go in and liquidate that. You might need an activist investor. An example of that could be Carl Icahn, to go in and actually liquidate that company for you or to unlock some of that shareholder value. If you're a minority shareholder, you're usually not in that position to do that. So you might be faced with a high opportunity cost if you do that. So it's definitely not something I don't think people should look into. I think it's very, very interesting. I just think that diversification, especially in these special situations, are very important. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.